All right, welcome and good morning to this Thursday, June 10th session of the ACA Small Business Bootcamp. My name is Faith Ritchie, and I am the Small Business Programs Manager here at the Arizona Commerce Authority, filling in for your usual host, Robert Theobald. As always, when we start these sessions, we like to give special thanks to our amazing network of community partners who have helped us create and present this content for the past 57 weeks. The Small Business Bootcamp is a free webinar series designed to help prepare small businesses of less than 20 employees return from the COVID crisis stronger than ever. It is a statewide initiative supported by our community partners, as well as a resource collective and content library. The resource collective is our additional tools and guides provided by our community partners to assist businesses in returning stronger through guidance, business essentials, marketing strategies. All of this information can be found at the website provided. Additionally, of our 57 weeks of sessions, we have recorded the majority of those sessions to create a content library. This content library can be found at the Small Business Bootcamp website. And if you scroll down to the screen, you will then see where it begins archived. So for the past 57 weeks, those recorded sessions will be listed and available to watch, as well as their attachments, their presentations, and that information is accessible and free for all of our small businesses. So whether you are looking for new insights or would like to revisit a topic, those opportunities are available for you on our website. As always, for additional COVID-19 information and resources, we recommend that you view the following web pages: ArizonaTogether.org and the Arizona Commerce Authority's COVID-19 page. Whether you are starting a business, growing, or building, there are programs available through the Arizona Commerce Authority to assist you in that process. From Small Business Services, Arizona at Work, and Arizona Manufacturing Extension Partnership, please take the time to review our website to see if any of these programs would be beneficial for you and your business. Also, a friendly reminder, the Arizona Small Business Checklist is available for those who are seeking to start a new business, to expand, or those looking to move to Arizona. This contains all of that information and commonly requested licensing information for local, state, and federal levels, and is available at that website provided. Now, Robert was able to share these updates with you all on Tuesday, and we will be sharing those links in the chat, but just some announcements that you need to know. The EIDL program is still available. Employee retention credit, we have done a previous bootcamp session, which is available in our archive. And if you qualify, we recommend for you to get more information regarding that, as well as the Small Business and Self-Employed Tax Center, and as always, the SBA Arizona District Office. And again, these links will be shared shortly within the chat. Now, while you are all here, our upcoming sessions for next week are listed on your screen. As you know, on today's session, Banking and Financial Ratios for Small Business Loans, we are happy to have our partners from SBD, Central Arizona, Northland Pioneer College, and Coconino Community College joining us again today. And next week, we do have 3 bootcamp sessions. So we will be meeting here, as always, on Tuesdays and Thursdays, but Wednesday, we will be having a special session for applying for the Paycheck Protection Program forgiveness. And as always, those webinars will be recorded and posted on our website as well. Now, to jump into our banking and financial ratios, I want to welcome back Gina, Katie, and Richard from our SBDC network to share their information with you all today. So without further ado, I will stop sharing my screen and I will turn the time over to you, Gina.
Thank you so much, Faith. Let me get my screen shared and we will go from there. So does that look right to you or do I have it backwards?
Oh, backwards.
Okay, there we go. So
Perfect.
thank you all for joining us today. Today we're going to talk about banking and financial ratios. My name is Gina Couliard and I'm the director of the Coconino Community College SBDC. So who is the SBDC? We're part of a nationwide network of center that delivers services to anyone who operates a business or is planning to start a business. We work with businesses at every stage from startup to sustaining to growing your business. While you're busy working in your business, we help you work on your business. Our links to register for either Katie, Rich, or myself are right here. And so you can contact us through those links. So what are some of the services the SBDC offers? We offer no-cost confidential business counseling, no cost to low cost seminars and training and new business checklists. Thanks to the ACA, we help you access capital, prepare for loan presentations, government contracting, marketing, and so much more. So we have a lot going on today in this presentation. I'm hoping that we can make it through it all. But the topics that we're going to cover today are the importance of good banking practices. We're going to explain financial ratios, at least some of them. We're going to go through how to compute some of those financial ratios so that you can apply those to your books and your scenario in your business. And then we're going to talk a little bit about doing some industry comparison using financial ratios. So as we get started, let's talk about a bookkeeping timeline. And we discussed this on week 1 of this financial series and kind of laid out a timeline of what tasks you should be doing at what time for your books. And if we remember and think back to that presentation, we remember the topic that, garbage in, garbage out. So as we move forward to your banking and your financial analysis, it's really important that you have good, clean, accurate records, because as you're going through and analyzing this data, you want to make sure that the information that you're calculating or addressing, that it's truthful and is what's really happening. So this is just more of a reference document, kind of a one-pager. I think you could print this up and put this in your place of work to kind of give yourself a timeline of what you should be doing and when. Now let's go through in our next couple of slides and address some really good just banking practices that you can implement into your business in terms of your management. The first thing that I cannot stress enough is time management. And I really like this image that's on the right, and it helps you assign a category to the tasks that are coming across your desk. 1, those are things that are crises and pressing problems. 2, it's something that you need to focus on strategies and values. 3 are interruptions, so you want to avoid these. And 4, you want to limit the trivial and wasteful. So as you're moving forward with your banking and all of these types of things, set a time to do it. Schedule a time when you can devote your attention and all of your thought into what you're doing. Have a clear idea of what your priorities are. One of the things that's going to be important as you're a business owner, especially as you grow and scale, is who has access to your bank and what kind of access do they need. Create a master bill schedule. This is really going to come important when we talk about succession planning or risk management, so that everyone or your successor knows when your bills are due. Utilize online bill pay. And then lastly, plan for emergencies. Even if it's just a small amount, save something for a rainy day. Now, in terms of banking, we also have all heard that adage, right? That cash is king. And we've talked to you each of these sessions, right, to check about your bank balance daily. And we're going to reiterate that here. So in controlling your cash, it's important to monitor your cash position daily. Set alerts on your phone, on your email. Just last night, I got a fraud alert on my cell phone. Someone used $7.20 in Indiana. Talk about how your customers are paying you. Are you making it easy for them to pay you? Are you having payment options that are things that they would use? One of the best ways that companies can manage their cash flow is to utilize and make sure that they have an effective collection process. This is a very good way for you to increase your cash reserves pretty significantly. And lastly, again, reserve, save for that rainy day. I love this little slide on here that says that 69% of small business owners have concerns about cash flow that keep them up at night. I know when I was in business and growing my business, I was definitely in that category. So let's talk about credit scoring. And credit scoring is important in terms of banking, both for you and your business. Your credit score is going to be important as you grow your business, but it's also going to have other factors, that could play into insurance rates, if you were bidding on a contract, or some of these kinds of things that want to look about your fiscal responsibility or sustainability. But your credit score does so much more than that. It helps you achieve your goals. It lets you target what you want to do. It makes additional funding sources available to you as your credit score improves. And lastly, it helps you build credit that maybe at some point, you could be off of the loan as a personal guarantor, and have the business qualify for something on its own accord. So your credit score is incredibly important. If your credit score is not where you want it to be now, that's okay. You can improve it, take steps, pay down debt, work on paying timely, and really set systems in place so that you can make sure that if you need to borrow money, you're in a position to do so. Now, the next thing I want to talk about in terms of your banking is asset protection. And this is super important. You work so hard in your business and growing your business and creating this wealth for yourself that you want to keep it. We've talked in previous slides how important it is to separate your business and personal accounts. We don't want any risk to be able to pierce that corporate veil. Do you have the right type of insurance for your business? Are the payments that you're collecting and what you're doing in terms of your financial activity, are they covered with cybersecurity? Do you have fraud protection for the type of activity and financial transactions that you're conducting? And then lastly, it's important that you manage your payroll and sales taxes. I personally suggest that every person set up a separate account just for taxes so that you can earmark those liabilities and make sure that you have those funds when they come due, because those penalties are so severe. So just take steps to minimize your risk and ensure that you're properly covered. Lastly, and I preach this to every client that I meet, in terms of your banking, you have to have an exit plan. And you say, well, how does this come into banking and financial ratios? And I'm going to tell you it's super important. The smartest businesswoman I ever met, in fact, she's an ongoing client with me, built her business with an exit plan in place. So everything she's done and everything she's purchased is with that succession plan, or being able to sell her business for her, retirement funding. So think about your exit plan. Who's going to take over your business when you leave? How do you want to retire? What are those assets and things that you want to have when you retire? How is your business valued? Most people really don't know. And a lot of the financial ratios that we're looking at and seeing here just very shortly are going to help you learn those things, and so that you can improve the value of your business, which will help you in turn have a better exit plan and hopefully more profit when you leave. And then lastly, who's going to continue your business in the event that something happens to you. You know, are your online banking records open? Do people have access to them? Do they know when they're due? So really crafting that exit plan, I think, is one of the most important things that we do as entrepreneurs. So with this banking information gone over, let's go through and start looking at some of these financial ratios. And I really enjoy personally looking at this information. So there's 5 different types of financial ratios. There's liquidity ratios, leverage ratios, efficiency and activity ratios, profitability ratios, and then market value ratios. And a lot of people start getting that deer in the headlights look when we start talking about financial ratios, you know, and I don't want you to be afraid. So think about this, right? These are already things we use today. You know, when you go and drive your car and you fill up on gas, right? You calculate miles per gallon. Well, what is that? That's an efficiency ratio. You know, we had a Camaro Super Sport, one of the fast ones, and my husband hot rodded that thing all the time, right? We were always burning up tires and he was burning up gas. His efficiency ratio wasn't very well, right? But when I drove the Camaro, I did much better on my mile per gallon than my husband. Definitely efficiency ratio. I can say that I am a more efficient driver than my husband. So let's talk about, you know, leverage ratios. And we think about that in terms of our personal life right now, right? How much money do you have in a home equity loan or a car loan, right? What's your debt to income or net worth kinds of things. Liquidity ratios, how much money do you have in the bank? Do you have enough money to make it to payday? These are all things that we already analyze in our day-to-day life. So just because the terms that we're applying in these financial ratios are a little bit different, doesn't mean that we aren't capable of calculating them. Now, I do want to talk about market value ratios, which is number 5 on this screen. And we're not going to talk about that a lot today. Those are really mainly for publicly traded companies. So we think about, you know, earnings per share, our stock price, you know, the price per share. You know, for some of you who may have a little bit bigger businesses that may have partners coming in and out, those may be something that you would use, but definitely not as much as the other 4. So we're gonna focus on the 4 today. So let's get started and look at some numbers. So liquidity ratios are the financial ratios that a company that measure a company's ability to repay both short and long-term obligations. So, I mean, there's a many number of reasons, right, that you would want to do this. Banks would look at this to know that if they're lending you money, that you're going to be able to repay them. A vendor could look at this, right, especially if you're applying for credit, to see if you have the liquidity to satisfy, you know, your open invoices. You may look at this in terms of a business to see if you have enough money to make it through the season. All sorts of reasons why you would want to apply these liquidity ratios for your business. Now, again, we're not going to look at every financial ratio that's out there. We're just going to highlight a couple so that you guys get exposure and some experience in learning how to navigate these. Now let's look at a current ratio, right? And a current ratio is calculated by dividing the current assets divided by the current liabilities. And so what this tells us is if we have enough money, sorry, my little screen's not being very good here. It's telling us that if we have enough money, enough assets to pay our current liabilities. Now, all of these examples that I've calculated in this spreadsheet are from the balance sheet and financial statements that we did in week 2. So this is information, and even from the cash flow last week. So this is information that we've been building on. So let's just highlight a few things in terms of this slide and all of them. Any of the data that we're calculating for 2019 are always going to be circled in green, and the data for 2020 will be in blue. And I've highlighted them so you know which numbers we're working on and can kind of just get a feel as these things move forward. So in 29, we can see that our current assets, right, which are prepaid expenses of 47,178, plus our cash of 45,356, which equals us 92,534. If we divide that by 35,149, which is our total liabilities, that our current ratio is 2.63. So what does this mean? Like, let's put this in English layman terms, right? So for every $1 of debt, we have $2.63 in assets. So that's pretty good, right? An ideal current ratio is 1-to-1. But for this company, they definitely have more assets than they do in liabilities. So let's go through and look at the same ratio for 2020, right? Our current assets equal 100,313, and our liabilities decreased to $16,046. So our current ratio now in 2020 is 6.25. So for every $1 in debt, we have $6.25 in assets. Now this would tell you a couple different things, right? A ratio, because we see on here that a ratio of 1.5 to 2.0 is considered ideal. So even though their assets are increasing, so we have an upward arrow, it's in red, right? There's an area of concern. Are they utilizing their financial resources correctly? Is there room for this company to grow and invest some money back into the business as they move forward? So let's look on this next side, and it is a quick acid test. So in this test, this is a little bit different than the last one we looked at, because in this, we are only using cash, measuring cash against liabilities. So again, our numbers for 2019 are in green, and our numbers for 2020 are in blue. So here we can see in 2019, we're taking 43,356 in cash, dividing it by our current liabilities of 35,149. So we see we have $1.29 in cash for every $1 in liabilities. This increases in 2020 to $3.87 in cash for every $1 in liabilities. Again, this is increasing. We're very liquid, but red because it's an area of concern. Are we really managing our cash correctly? Could we expand? So let's move down to our next slides and start talking about leverage. So a leverage ratio is any one of several financial measurements that assesses the ability of a company to meet its financial obligation. A leverage ratio may also be used to measure a company's mix of operating expenses to get the idea of how changes in output will affect operating income. So common leverage ratios include debt to equity ratio, equity multiplier, degree of financial leverage, and consumer leverage ratios. So let's put this into action and see how this plays out for our business. So let's look at our debt ratio. And for this, we're using our balance sheet again, but again, we're using a little bit different information, right? Again, 2019 is in green. So we're going to calculate our debt ratio, we're going to take our total liabilities and divide it by our total assets. So our total liabilities, which we can see down in the liabilities section of our balance sheet, is 35,149. And we're going to divide that by our total assets of 129,409. So this includes cash, inventory, all of those things. So this means in 2019 that we had 0.27 cents of liabilities for every $1 in assets. So not a significant amount of debt. And we can see that our debt ratio, right, actually decreased in 2020. So usually the higher the ratio on a debt ratio means the more leveraged your company is. So if you have car payments, equipment payments, a building loan, and all of these things, your company could definitely be more leveraged. This is absolutely one of the ratios that a bank is going to look at in terms of lending you money. And so, I put this little piece of information on here that a debt ratio of 0.50 is considered an ideal financial ratio. So this is decreasing in terms of their debt. The arrow is green because this is a healthy assessment. So let's move forward and look at some efficiency ratios. So efficiency ratios are called activity ratios. They measure how well companies utilize their assets to generate income. Efficiency ratios often look at the time it takes companies to collect cash from customers, or the time it takes companies to convert inventory into cash. In other words, all of these things make more sales. These ratios are used by management to help improve the company, as well as outside investors and creditors looking at the operations of profitability of the company. Efficiency ratios go hand in hand with profitability ratios. The more efficient you are, the more profitable you are. So there's a whole bunch of ways you can measure efficiency. And so I'm just going to go over on the next slide some very common efficiency ratios, and we'll look at those. So things that you can look at in terms of efficiency ratios, right, are your inventory turnover ratio, your accounts receivable turnover ratio. Again, remember when we were talking about our banking early on and we talked about our collections, having that really sound collection policy, the quicker you turn that accounts receivable, the more profitable you're gonna be. And like Rich and I were talking about before you all got in here, just little tweaks can make huge differences. So if you reduced your, accounts receivable, say from a net 30 term to a net 20 or net 15 term, the effect that that has on your bottom line could be substantial. So we can also look at our account payable turnover ratio, sorry, tongue-tied. Are you maximizing your discounts, right, on your accounts payable? Fourth one for inventory-based businesses is incredibly important. How often are you turning over that asset or that inventory, right? Do you have dogs on your floor that aren't selling? Can you replace those with items that move more quickly? And then lastly, the days the sales are in inventory. These categories can have enormous changes on your business. So let's look at an example on the next slide. And this one, we're not going to use information from our balance sheet and income statement because we didn't generate that. Now, if you have a service-based business, let's talk about that as well. If you have a service-based business, you're not going to have an asset turnover or day sales or inventory. But what you may have is, say you're a pool person carpet cleaning business. You're a carpet cleaning business. And after each carpet clean, right, you have to go and clean out and dump the water from your truck. Well, if you have a location that's very far away for you to dump the used water from your truck, that's going to be less time that you can spend billing and cleaning another house. So maybe by finding another dump facility that's really close to your service area may allow you to add 1 or 2 more service calls in a day, which would increase profitability. So service-based businesses may not always have the inventory component that inventory-based businesses have. So let's look at another example that's just on labor productivity. And we could all think of this in our business. Are our employees being productive? So let's talk about this, right? So to gauge labor productivity, we want to take the employee's total output by their total input. So let's say that a company generated $80,000 worth of goods in 1,500 hours. So to calculate the labor productivity, it would be that $80,000 worth of goods, right, by 1,500 hours. So it's $53 per hour of work. well, what if you could reduce or streamline a process or create more efficiency, and you could get this down to 1,000 hours to create this $80,000 worth of goods? That would mean that you're generating $80 per hour of work. Now let's look at the example on the bottom of this slide. A company generated $80,000 worth of goods or services with 30 employees to calculate the labor productivity. So that $80,000 worth of goods or services with 30 employees means that each employee is generating $2,666 a week in revenue. Now, what if you could do this same thing with 15 employees, right? You would increase your revenue per employee per week. So it's really important to, in terms of your productivity, to see what people are producing and if there's efficiencies that you can model in your business to increase profitability. So the last one that we're going to talk about is profitability. And remember, we talked a lot that those efficiency ratios really play into this, right? If you have an inefficient system, you're probably not going to be super profitable. So profitability ratios indicate how efficiently a company generates profit and value for its shareholders. Higher ratios are generally more favorable. And then these ratios provide much more information when you compare them against other competitors, but mainly against yourself, right? Are you more competitive? Are you more profitable this year than last? I don't know too many people who like to go to work year over year and have their profits reduced. So let's take a look at some of these and see what our financials for our example business are telling us. So an operating margin ratio measures how much a company makes on $1 of sales after paying variable expenses. So when you're doing a simple profitability ratio analysis, the net profit margin is the most often margin used. So let's talk about what's happening in this slide. So, and again, this is the income statement from our example. And so if you look on the left at the income statement, for those of you who were with us when I did the work session on financial statements, remember I told you that if I would be concerned to see that my net income dropped and my sales increased, right, from year over year. But what this does is it kind of puts validity to your concerns. So what we're doing is we're taking our operating income in 2019, again in green, of the 554,504, and we're dividing it by we're taking our net income, 56,139, and we're dividing it by our revenue. So this means that we have 10 cents of profit for each dollar we sell. Not terrible, but then we look at 2020, right? And we can see that our profit has dropped by 6 cents per dollar. So I don't know many people who would be really excited to know that they're losing 6 cents on every dollar, especially when those dollars add up. So this is a major concern. Although our sales are increasing, our operating margin is decreasing. So this is definitely something that you would need to look at. What do you need to address? But now as you have this information, you've got 2019, you've got 2020. So now you can start making changes, right? And hopefully we can see a trend as we calculate this ratio and start managing it to see if that trend's going to start going upward in the next year or two. So let's look at another one that's really important, and that's the return on assets. And this one's kind of cool because it uses, your income statement and your balance sheet together, right? And so you're really getting to see how these resources are working together. So for your return on assets, you take your operating net income and you divide it by your total assets. So again, 2019 is in green and 2020 is in blue. So we can see that our return on assets in year 2019 was 43 cents. And then in 2020, it was 18 cents. So what we can tell is that our assets are having a declining return. Now, if I were an investor or a business owner, I would want to be making sure that my assets are increasing and generating me the maximum value that my business can sustain. So again, for me, this would be an area of concern. Now, let's move forward and talk about how you can take this information and start talking about benchmarking. Now, when we talk about benchmarking, benchmarking is a way of discovering what is the best performance that you can achieve. You can benchmark yourself internally, so year over year, so for these examples, we've seen 2 years. Or you can benchmark yourself against a competitor, or you can even benchmark yourself against an entirely different industry. So we know, some industries have very, very thin profit margins, and they have to make that up in terms of sales volume. Now we have some industries that have very high profit margins and very little sales. And so, it's interesting as you get more fluid and comfortable with this to see how your industry stacks up against others, but definitely against yourself. By taking this time to benchmark yourself and really understanding these ratios and what they mean for your business really puts you in the driver's seat for operational decisions and really puts you in control of your financial future. Again, even just very, very small tweaks can make a huge difference long haul for your business, both in profitability, but in value of what your business is worth. So let's go through and talk about what the benchmarking process looks like and what that may mean for you. Well, actually, before I do that, let me talk about this a little bit. So the SBDC has a whole bunch of wonderful tools in terms of benchmarking. We have a program called Profit Sense that your SBDC advisor and yourself could work with to see how your business is stacking up against the competitors. We have some reports called IBIS World Reports that you can contact your local SBDC office that gives you industry specific information on your industry that has outlook, factors that are affecting the industry, what traditional ratios are for your business. I just really enjoy reading them. And then for those of you who are using the advanced version of QuickBooks, QuickBooks also has some really great benchmarking tools in that advanced version. Now, if you're not that advanced QuickBook user, please don't push yourself to that level. Just reach out to your local SBDC and they can help you with some of these free tools and help you understand what they mean for your business. So let's talk about a benchmarking process, right? So before you start benchmarking, you need to really determine what you want to study, right? And you need to be specific. And so as you're going through and you're planning, say you have 5 areas that you want to work on. We as humans just generally aren't that talented. So pick one area that you would really like to focus on, or maybe 2. So make a plan of what you want to look at. Then collect the data. What kind of data do you need to benchmark yourself? Are you looking at employee productivity? Are you looking at return on assets? What kind of information do you need to collect to begin this process? And then also, is your data accurate? We're going to go to that term garbage in, garbage out. We have to make sure that the information that we're using is the most up to date and is accurate. Then we need to go through a process of data or analyzing that data. We can use financial ratios. Maybe some of it is looking at our service calls, right, on our employees. How are you going to analyze this data you're getting? The 4th step in this process is to make an implementation plan. So how are you going to tackle this problem? How are you going to tackle this project that you have? And then lastly, the step that you're going to do is monitor it, right? You're going to benchmark it and start looking at these ratios quarter to quarter or year to year to make sure that once you're operating at that maximum efficiency, that you continue to operate, that maybe a cost hasn't gone up that snuck up on you that you weren't aware of. So it's not a one and done. It's going to take that constant monitoring for you to make sure that you're always maximizing your efficiencies, and then the process can start all over. So let's just look at an example of one of these that I've done in terms of our company here. So if we look at, and we all know SMART goals, right? They're used a lot in businesses. So for you to have goals and for them to work, they have to be SMART goals. So they have to be specific, they have to be measurable, they have to be attainable, they have to be relevant, and lastly, they have to be timely. So let's talk about this in terms of our return on assets. Remember, our return on assets went from 48 cents a couple slides ago down to, I think, 18 cents. So our return on assets was decreasing. So our specific goal that we want to focus on is that we want to increase our return on assets to at least 30 cents. So how are we going to do this? How are we going to measure this? So our Chief Financial Officer will track and report our return on assets monthly to senior management so that that management can make adjustments to utilize our assets better. So how are we going to attain that? So CFO will work with purchasing to identify areas for expense reduction. Why is this relevant? Our return on assets provides us a measure of how our firm is converting our assets to net income. So super important to us. We want to make sure that we're maximizing all the income that we can have. And then lastly, how are we going to improve our return on assets? Or how long is it going to take us to improve our return on assets? So for this example, I've said that we want to have a 12-cent increase from 18 cents to 30 cents by the end of Q2. Now you could flesh this out and build a whole lot more information in here. Maybe there's specific things on measurement or those kinds of things that you could put in specific goals, so maybe reach out to supplier and see if we can reduce cost of goods sold, check on a different plastic manufacturer. You could take specific steps and get even more specific than you are in this example, but at least this gives you a tree and a start of where to begin that process. So lastly, before we open it up to questions, I just want to thank all of you very much. This is the end of our series. I want to thank you all so much for your time. It has been an absolute pleasure to be here with my colleagues and partners to present this for you. Here is our contact information. If you have questions, please reach out to one of us. We're happy to help you and assist. And like I said, your local SBDCs are a great resource for some of these free tools that you can have in terms of your financial ratios and benchmarking your business. Katie, Rich, did I leave anything out?
No, I just want to add one quick thing from a kind of a business owner standpoint. Let's talk about just for a second how we take this off of a piece of paper and put it into how you use it. I had a client like this that had inventory in a warehouse, and they made one bad buy, and it was like purple raincoats that never sold. And so every time they would walk by that in the warehouse, they'd look the other direction because they didn't even want to see it. And then they made it the second bad buy and the third bad buy over a course of years. And pretty soon it was a little section of the warehouse that hadn't sold. And they were like, oh, I don't want to bite the bullet and either sell it at a loss or whatever. But we were able to go in with efficiency ratios and show them what their asset turnover was really costing them, what the inventory days were really costing them. And once we could put a value on what the purple raincoats were costing sitting there, it was much easier for the owner to make the decision and say, okay, I'm selling them at a loss. I'm getting rid of it and doing all of that. So I would suggest to you that the ratios that are here, and for me especially the efficiency ratios, really helps making decisions. And if you kind of have one of those, I feel like I ought to make this decision, but you'd like here it's on paper and it says that I ought to make this decision. If you're like that, the ratios can really be your friend in helping you get to a decision. So that kind of brings it to everyday use, I guess.
I want to expand on that a little bit too. I mean, not just the purple raincoats, but say you're having a service-based business, and we're talking about that carpet cleaning business again, and you have 4 employees, and 3 of the employees can clean 8 houses a day, but the 3rd and 4th employee can only get to 4. It also helps you craft internal policies and procedures and goals, expectations for your business that help you manage your labor force effectively.
Excellent. For those of you with questions, don't hesitate. Please post those in the Q&A. We do have a few more minutes. I'm going to take some time myself to thank you, Gina, for breaking that down for us. I know a lot of people get hung up on that, so thank you for taking the time to walk us through it in this session.
So my team, we're made up of, out of the 3 of us, we have 2 accountants. So anytime that I get the opportunity to look at financial ratios with someone is a good day for me. I have much more exciting interest than that in my real life, but.
Oh, I love that. All right. We're going to give a few more moments for questions. Oh, any tips for applying all of this advice to a sole proprietor business? Was posted in the chat.
So it's no different if you're a sole proprietor or if you're a 3-member LLC. You can still use, especially like your leverage ratios and things like that, to see how you're managing your debt. You can still look at your efficiency ratios, especially say you're a sole proprietor and you're a pool cleaning business. How many pools can your competitor clean a day, or how many clients can they serve? It may give you these efficiency ratios, may give you ideas that you need to, manage your time better, so that you have more of that sales time, right, than the tasks that aren't benefiting you financially.
Excellent. Thank you for your question, Sherry. James posted a question in the Q&A. Do you feel it's a good idea to have a line of credit from a bank?
I'm going to take that one. And James, without knowing your financial situation, it would be impossible for me to answer that, and it would be really unprofessional. I don't know your full history. I would speak to your financial advisor or your accountant to make sure that you have adequate cash reserves and lines of credit for your business.
Excellent. Thank you for that, Gina. We'll allow another moment for any additional questions. But thank you so much, Gina, Katie, and Rich, for spending the past few weeks with us and providing this much needed information to all of our small businesses statewide. I know it's going to be a beneficial addition to our content library, and I'm sure many small businesses will revisit this information. We don't have any additional questions, so I'm going to give everyone 10 minutes back in their day. But again, thank you all so much for your time and dedication to this topic in the past few weeks. For those of you joining our Small Business Bootcamp, we look forward to seeing you return here on Tuesday at 9 a.m. So thank you all and have an amazing day.
Thank you.
Thank you so much.